Now the biggest problem is most accounting firms, they didn't have a virtual strategy. They had none. And firms have got to figure out how to practice virtually, and it's just not what they think it is. We're not going to go back to where we are. And where we are today, we're not going to be where we are today, but we're going to end up somewhere in the middle. And firms have got to figure out how to do this.
This is the Staying Power Podcast, a show that explores the challenges business owners face as they grow. I'm Brandon Hall.
And I'm Thomas Castelli.
And together, we ask the tough questions to show you that running a business is not for the faint of heart. But if you have staying power, you'll overcome your challenges and achieve lasting success.
Hi, everyone. Thanks for tuning in to today's episode of the Staying Power Podcast. We're joined here with Gary Shamis, principal at Winding River Consulting. Gary spent a lifelong career in accounting, growing his father's accounting firm from $225,000 in revenues to approximately $100 million before selling it to national accounting firm BDO. In today's episode, Gary shares his secrets to success as well as the challenges he faced along the way, including strategy versus execution, how to acquire and retain top talent in professional service businesses, why it's critical to figure out how to operate in a virtual environment to survive and thrive in the current and future economy, and so much more. Gary, thanks so much for taking the time to come on the show today. Can you give our listeners a little information on your background?
So I went into the accounting industry back in the late 70s, and I worked for one of the big 8 accounting firms. I left there in 1981, and I joined my dad's accounting firm, which was a small accounting firm in Cleveland, Ohio, doing about $225,000. Over the next 34 years, I ran the firm for 27 of the 34 years, and we grew the firm and the organization from the $225,000 to about $100 million. Sold the organization January 1st of 2015 to BDO, which was the 5th largest accounting firm in the world. And this was the largest transaction BDO had ever done as an organization. So between those 34 years, there's a lot of stories and a lot of histories. But that's really the background on where I took my firm from a professional standpoint.
That's huge. You started with $225K in revenue and you grew it to $100 million over 3 decades. Let's say that you're talking to somebody that wants to do something very similar to that. What would you attribute to the success, or what's like the number one thing that they should be focused on to get to that level of scale?
Well, the number one thing that they should focus on is the ability to execute. Strategy is easy. Execution is really hard. And, what I found in my career is that everybody has the same access to the strategy. Yeah, there's some innovation possibly, but everybody has the same access, and some are more successful than others. And the ones that are more successful are the ones who take the time to execute. There was 3 strategies that we put in place that really was the difference maker for us in going to where we were as an organization. And the first strategy was really having to do with becoming really focused, niche focused, vertical focused as an organization. What happened was really in 1999, we took upon ourselves to take that strategy going from really just a general player to a very specific vertical player. Our verticals were all industries. A vertical could also be a service line too, but we really never had a service line. It was more related to a specific industry. And we had about 6 or 7 different industries we focused on. Now, being capitalists, we would do work outside of those industries, but we just didn't put the resources behind it in terms of marketing, growth, educating our teams and things like that. But we ended up focusing and becoming much more focused. So that was really huge for us. The one that we became the most famous for was the restaurant industry. And what we did is we really started with a couple of restaurants. And by the time we sold to BDO, we had 500 restaurant clients from coast to coast. It was about 20% of our business. There was no competition. There was all these reasons people didn't want to be in the business, accounting firms, and they were all really bad reasons. They just didn't really know. So it was, if you go back to the book on Blue Ocean, it was just amazing. I remember doing the research back in really the late 90s, early 2000s as to who the competition was. And the restaurant industry at that point in time was the 2nd largest employer in the United States behind the federal government. And there was like no dominant players. And there were a few earlier on. There was some other quasi-national firms that had gone out of business. But it was just such a blue ocean. It was just such an opportunity. So we really seized on the opportunity there. And then there were some other industries as well. One of them that we saw another blue ocean was independent pharmacies. You think independent pharmacies, what are those? Anybody who lives in any kind of city, the only pharmacies are Walgreens and CVS. And the reality is that there's more independent pharmacies than there are Walgreens and CVS's, but nobody focused on them. So we had a huge focus on independent pharmacies. We did real estate. We did not-for-profit. We did employee benefit audits and a couple other areas. So we became very, very focused in terms of what we're doing as one strategy. The second strategy we did was really broaden our service line. And again, we weren't really geniuses here. What we were really doing was really focusing on what the Big Six was doing back then. And that was selling more to individual clients. And you really saw no CPA firms do that. So we ended up with a very broad service array and, take a typical client that was buying, something from you, generally tax or maybe an audit. And we figured out, can we sell them more in different service lines? So we got much broader. We had payroll, which was significant for us, wealth management. We did retirement plan design and administration. We did some HR consulting and other things. And then through that, we offered some of those to different businesses, and those businesses grew fairly large. So number one, they were making money that contributed back to the CPA firm partners, which was good. And number two, after we sold the firm to BDO, we ended up selling the ancillary businesses. And just interesting, the CPA firm on a revenue-related basis was the least profitable business we sold versus the other businesses. So the other businesses sold for much, much higher multiples than the CPA firm.
That's fascinating.
And then the third area of growth was we were in Ohio. Ohio is one of very few states that have three large major cities. If you think about it, it's really just a strange phenomenon. I think the only other states that have three major cities is California and Texas. And there was no firms that were in all three of those major metropolitan areas. So first we ended up in Cincinnati through a story. And then once we were in Cincinnati, we said, let's put in Columbus. So before you knew it, we were in all three major cities in Ohio, and we were the largest firm headquartered in the state of Ohio. And then from there, we grew. So we really had three different strategies. One was a broadening service. Second was really a vertical strategy. And third, there was a geographic strategy. Today, given what's happened, there's some other strategies that I think are really interesting, but those are the three that drove us forward.
So when you picked the vertical restaurants, for example, how hard was it to scale initially? And did it all kind of happen organically later on as you're making a name for yourself and a brand for yourself? Talk to me about the growth. Was it exponential at some point?
No. It was a degree of patience with this thing. And, you think you have a great idea and, you see things today in today's world grow, virtually so quickly. It just wasn't like that. We started the restaurant niche in 1995. We sold in 2014. That's 19 years or 20 years. And that 20-year period, we grew to 500 restaurants. So multiply that out. That's 25 new clients, over, 25? Yeah, 25 new clients over a year. So that's one client every 2 weeks. And that's probably was it. We were adding clients on a regular basis, but it wasn't, going to this, huge different level quickly. And also from a growth standpoint, I think that would be hard to manage as well, too. So it was moving forward, adding on as we went. People used to always ask me, I used to love this question. People used to always ask me, do you ever think you're going to get as big as you're going to get? And the answer was, we never really targeted revenue growth as an organization. What I wanted to do running my organization is every year I wanted to be better than I was the year before. So it was this whole idea of continuous improvement. And if you take enough time and you really have that strategy and throw it on top of each other, that's what you end up with. $100 million is impressive, but when you take that to Ohio, it's even more impressive. Ohio had the second slowest growth rate of any state over that 34-year period. So we had no tailwinds. We only had headwinds in growing this organization.
How did you know when it was the right time to add these additional services? You talked about all these additional businesses essentially that you built out, wealth planning, retirement account management. Talk to us about how you go about recognizing those opportunities and then setting that up.
Well, one of the things that was really interesting for us, and we were really lucky, is when I joined the firm in 1981, long story, but that's when we launched the payroll company. So we had a comfort going way back to 1981 and offering multiple services to clients. We would try and cross-sell services. Most firms didn't have that. So once we started understanding and really just watching what the Big Six was doing, what the Big Six had done, and they went through a cycle on this, is they basically had to commoditize the audits, gave the audits away to sell other services. So looking at their strategy, all we did was copy their strategy. And their strategy was, look what they're doing. They're offering all these additional services. So keeping an eye on what others were doing. And then that's like I'm saying, strategy is really not, there's not a whole lot of secrets to strategy. It's just, do you have the light bulb on and you have this degree of awareness? And if you do, it wasn't hard to see it, just whether to copy it. And given the fact that we were comfortable with that because of having this payroll company, it was relatively easy to do this. But, I talk a lot about doing this and some of the things I'm teaching today, I talk about how this model is shifting and we're going to this financial services model. I really believe that's the way that we're heading. We're going there. So part of the question is, once you identify where you want to head, how do you get there? And there's three ways to do it. Either you buy a company that's doing it right now, either two, you partner with somebody, or three, you grew it. We were very control-oriented, so all the companies that we built, we grew. We never bought a company outside of our basic service line. Now, once we started, we may have had an add-on acquisition, but everything we grew organically from the beginning. Takes longer to do that, but you have a much more control over service and things like that.
And I just want to circle back to a comment you made before about how, you're taking on about one client every 2 weeks and to grow restaurants and how to grow much more than that. And this might've been something you said on another podcast too. The infrastructure can't keep up. Would you be able to just dive into a little bit about that and what needs to happen from an infrastructure perspective when you're, in a high growth mode?
Yeah. So I spent a lot of time talking about how we grew it. And I haven't spent as much time. I have talked about it as how to build the service capability behind it. And it kind of like, when I wrote this down the first time on a scratch piece of paper, this is the marketing plan. On the right hand of the sheet was like, what happens if we're successful? How do we really do this? And for us, it was really figuring out how to grow that side of it. I could tell you in the end, in the beginning, I did a couple restaurants and a guy named Brad Saltz did a couple restaurants. In the end, when we sold the BDO, we had 60 staff and 7 partners who woke up every day and did nothing but restaurants. Now, once we got to that level, it was really easy because they all wanted to learn more. We were able to educate. We had enough money to invest in terms of educational content and the service line of it. But really, it was in the beginning, it was, taking some of our existing staff, having this person work on a restaurant, give them more restaurants. Before you knew it, they had enough that they could only work on restaurants and kind of adding. One of the real keys for us was really focusing people exclusively on that market. Most accounting firms won't do that. You're going to say, well, this person works on restaurants. You go ask that person, would you have any other clients but restaurants? Of course they do, because they want to fill up their time. And we got to a point where we started loading people up with this. And interesting enough, in today's world, today's world, maybe not a good place to bring it up, but, before the pandemic, restaurants they're like a cultural aspect of our society that people really liked a lot. And you would have young people who would love to work on these restaurant clients. I loved restaurant clients. I talk a lot about it on the book. I loved it because I just loved the owners. The owners were just so unique from the owners I would run into with respect to my traditional type practice. And there was a lot of people who were just kind of, they were like drawn to this type of culture within these restaurants. So it was easy to get people wanting to do it once we started picking up the traction. But it really was focusing on educating them, becoming good at it, and just keep adding to it. We got to a point where I made one hire. It was just an amazing hire. I was going to this big restaurant conference every year. Huge, 2,000 people there. And one year I noticed this guy who was walking through the conference and his name's there and his company's underneath him. And this company was the Internal Revenue Service. And I'm thinking, wow, what is this guy doing here? So I didn't talk to him. The next year I go to the conference, he's there. I go up to him and I said, what are you doing here? So he tells me, he says, well, what I do is I run the restaurant practice for the IRS, and I come to this conference wanting to see what was here. So I said, would you mind if, I spent a little time with you? I'd like to understand what you're doing and get to know you and what you know about the restaurant business. Hit it off, made a friendship with him. At the age of 55, he decided he was going to take early retirement from the restaurant industry, and guess where he came to work? At SS&G. So now we had the number one person in the United States in the restaurant industry. Now what happened was there was some new regs that went in place that had to do with capitalizing cost into inventory that focused on the restaurant industry. And he wrote the regs. Nobody really understood how to implement that. He came and joined us. And the next thing I know, we were doing work for 25 public companies. One or after another were coming to us and saying, hey, we don't know how to do this, but you got the guy who wrote the regs. So, and he was an add-on. We added him on, huge value.
So it sounds like part of the growth came from acquiring talent, right? Acquiring the right talent that could add expertise to the business.
Yeah, and I talk a lot about that in my most recent book, and it's called Building Blocks, and that's the most important block. The most important block is to get the right people. You know, you just can't make an investment in a bad person, and you just got to get the right people in place. So that's it. I tell a story about it. Maybe let me just tell you the story. It's in the book, and I think the story best epitomizes, my thinking on this. This is way, way, way back, 1989. 1989, I had about how many people did I have working in my firm in 1989? I probably had 18 people working in my firm in 1989. There was a firm in Cleveland, Ohio called Copperman and Wolf. They were, in my mind, the best local firm. They epitomized what I wanted to be as an organization. That's what I wanted to be. I wanted to be Copperman and Wolf. Great reputation. You just thought that they were an incredibly great firm. So they had 30 people working there. They were bigger than us. They'd been around a lot longer than we had. And what happened was they had one client that represented 1/3 of their business. I didn't know that, but they had one client that was 1/3 of their business. Beginning the busy season of 1989, so that bled into 1990. They found out they were going to lose that client, their largest client, 1/3 of the business. But they had the client through busy season. So word got out, and what happened was they let 10 people go, something like 10 people. No, they had 45 people. They let 15 people go on April 30th of 1990. I asked the managing partner, you're letting these people go. Would you give me their contact information? We like to contact them and see if any of them would find a home with us. So, of course, he said yes. He wanted these people to find a job. I interviewed all 15 people. I hired 5 of them, and I didn't need any of them. Okay? We were a firm of 18 people. I added 5 people after busy season when we don't have as much work in 1990. When we sold to BDO in 2014, 4 of them were still partners with the firm. So think about the risk that we took on hiring these people, and think about what they did for this organization over the next 25 years, where 4 of them became partners and were still with the firm. It was really amazing return on investment with these people.
How did you know it was the right move to hire them and take that risk?
I just was committed to having the best people around me. That was always my strategy. I knew I wasn't the best accountant, and I knew that to be successful, if I could surround myself with just really, really great people, I would be successful. So I knew that from the beginning, and I wasn't scared to do that. It probably was in my entire career with my old firm, which was 34 years, it was one of 2 years that I had a reduction in compensation. That year and then the recession of 2008 were the only 2 years that I ever had a reduction in compensation.
Interesting. So you're working on building a team out, and you've built a big team out. How do you really give each employee clarity as to what their role is and how they can be successful? And what sort of expectations do you hold them accountable to?
Well, one thing that we did, and I don't even know if I even talk about it in the book. Maybe I have to rewrite the book. I probably did. In 1995, what we did was we put in an employee stock ownership program in the firm. It was a phantom program. They really couldn't own stock in the firm. What we did is we developed a program to allow employees to invest in the organization. And their return, they had a minimum fixed return that we paid to them quarterly, assuming that they went to the bank to borrow the money, to invest in the firm. So we had to give them some cash flow to pay their what their borrowing was. And then we gave them additional interest, and the additional interest was based upon the growth of the firm. We sold in 2014. We paid our employees millions of dollars in return on their investment in the organization. It was actually covered by the Wall Street Journal in 1995. They did an article on it. And it was really valuable in terms of culturally letting our employees know they were a part of what was going on. And, so things like that is what we did from an organizational standpoint. Also, when you hire great people and you continue to hire great people, you just don't have to worry as much about, things like keeping them in line, keeping them motivated. If you just continually have just amazing people, and there were strategies involved too. One thing I talk about a lot was we were the largest firm in the United States that wasn't headquartered in a major city. We were headquartered in Solon, Ohio. And one of the reasons we did that, and this really goes back to strategies in the 90s, and this had to do with working mothers, where the big four used to think if you were a working mother, you were brain dead. And what we said was we ended up wanting to be in the bedroom community. So these women who were working for the big four, the big six, who couldn't work there anymore because they wouldn't adjust their schedules to allow them to take care of, life responsibilities. We had part-time women. We had part-time partners. We tried to be in the communities where they could be close to home to pick up a sick kid or go to see a counselor for the day. So we really tried to focus on trying to look at talent. There was points and times we had waiting lists of people who wanted to work for us. Women who were working for the big four, big six accounting firms who were like, let me know when you have an opening because I'd love to be able to work for your organization. So we try to do things to have talent find us rather than us finding talent.
I think putting all that stuff in place is great and definitely motivating for employees. You're hiring great people. Good people love to work with other really good people as well. Give them a little bit of a slice of the company and that future growth potential, gets them bought into the mission and kind of that one firm approach. I guess though my question is at the end of the day, you still have to be able to set expectations for employees and hold them accountable to something, or is that a false premise and you don't? You just hire great people and you let them run with it?
Yeah, I talk a lot about this, and I think there was three aspects to the success of our firm, and a lot of them are going to fly in the face of what is considered to be normal today. So the three things that we focused on was we focused on our people. We focused on getting the best people we could and taking care of our people. The second thing we focused on was servicing our clients and having just a great client service model. And the third thing we focused on was growth. And if you would look at almost any accounting firm today, one of the things they're going to focus on is partner compensation, net income per partner. It's just, and then having spent the time at BDO in a much larger organization, seeing the metrics, everything is so metric based. Our philosophy was if we do these three things right, then we're going to have a great organization and profitability will be a byproduct. So, of course, you need to have chargeable hours. You need to have partners produce. And you need to have all those kind of standard things you got to run your firm by. But in terms of looking at organizations and how they're so metric-based today, it was much different. I sold my payroll company to CBiz. We sold it actually a year ago today to CBiz. CBiz is a publicly traded company. And, what you could see, which is really interesting to me, the same thing at BDO. BDO and CBiz are really interested in revenues, but they're not as interested in clients as we were. And to us, it was a direct connection. We were more interested in clients to get revenues. They're just more focused on metrics of revenues. So we were much more focused on that. That is a whole interesting thing within my life. I continually wanted to grow this organization larger and larger and larger. And once we got to a point when they got really large and actually selling them to these large public companies, they're just so different from the way we operated. And we just weren't we didn't make decisions as much based upon metrics as we did, really focusing on those three elements of our stool.
If you were the sale potential again, would you go through with it again, knowing what you know now?
Today, given what's going on with the pandemic, would I desire to be running an organization as large as I was today? No. There's going to be significant layoffs in the industry. We're going through a huge recession. I made some prediction that those layoffs are going to start today. If you look at the largest firms in the country that weren't able to get PPP loans, 70% of them already had significant layoffs. We're going into a recessionary period of time. It's hard to do things like that. Firing people. Would I want to do those kind of things today? The answer is no, I wouldn't. I'm kind of glad that I don't have that responsibility. And some of that just comes with, my age and, the stress related to that. But when we sold the organization, when we sold the accounting firm, I did not want to sell the accounting firm. I did not want to do it. I had 33 partners. There's a story behind that. Our partners decided that they wanted to sell the firm. Within 5 years, we were down to 6 partners or 7 partners. Most of the partners were gone. And I didn't really understand it, so maybe I did understand it. So personally, I would have not wanted to sell it. I thought we were in a great position to move forward, but I wasn't the one who's going to be moving us forward forever. So some of the responsibility on that decision went to younger partners in terms of how they wanted to move forward with that decision. But, the one thing you learn about that is you lose control. You have to decide, is there enough money there that you're willing to take the money to lose the control? Because you lose the control. How important is that to you?
I just wanted to circle back one more time to the people component of it. One of the things that you discussed, and I completely 100% agree with, hiring great people is one of the best ways to grow and to make sure that your clients are serviced, right? But what was your take on inexperienced hires, people from college? Was SS&G and the company, were you developing those people? And if you did develop them, how did you go about doing that?
So I had a change in thinking along the way. And originally my thinking was I did not and was not interested in new hires. One of the reasons I wasn't interested in new hires, and especially I'm talking about, maybe when the millennial generation started and the millennial generation, at least at that point, was known for maybe lack of loyalty or wanting to experience different things. So I always felt that if I was the first person to hire somebody, I was at a huge disadvantage because they had no basis of comparison. They didn't know if this was a good place or a bad place. They just didn't know that. They could ask their friends and try and make those kind of comparisons, but they were anecdotal comparisons. They really didn't live those comparisons to know them. The other thing is it's a tremendous amount of money to train these people. And given the fact that they may not stay, is that really the best thing you can do? So in the beginning, I really like to hire people who had a couple years of experience. But the problem with that is finding them. Because when you go to hire your first group of people, I could go to Ohio State and I could find 200 people who graduate in accounting. They're all in one place. Once the diaspora happens and those people go everywhere, how do I find them? It's harder to do that in terms of finding people on a rebound or in a second position. So that was in the beginning. But in the end, what happened was we had gotten so large and we had such a need for people, we just really couldn't do that anymore. So we had to go to the hiring. And what happened, and you guys kind of know this whole notion of the way the interning worked, that turned out to be really pretty good. I mean, we were heavy on the interns. We used to hire 20 or 30 interns during a busy season, try and give them meaningful work. We didn't do summer internship programs because that was just fluff. We didn't have the work for the people. So we wanted people who were really willing to work, who were willing to drop out of school for a semester or a quarter to work for us and be there. And then that was a great place to try and test the people and get the best people we can. But now the challenge came, could you give them enough to keep them to stay and get rid of the ants in their pants on the 2 to 3 years that they want to leave and try something new? That was really the challenge, what we could do to do something like that. And we really worked hard at it. We had incredibly low turnover. We turned over about 8%, which could have been the lowest turnover any major firm in the country. In some offices, our Cleveland office used to turn 2-3%. People wouldn't even leave, which is not the healthiest thing either. But we really worked hard at their retention. I've always said this about public accounting. The best way to make money in public accounting is to have the same person work on the same client year after year. It's the best way to make money. The worst way to make money is to have a new client and a new person. So if I could keep people working on a client 1 year longer, I improve the profitability of the practice going forward. So what am I putting in place to keep that person in a longer work environment?
Yeah, it sounds like, basically it's if you're able to hire great people who are already experienced, that's obviously an advantage because there's less training. You don't have to put that much investment into them. And because if you're going to go the route of hiring new people who don't have experience, you have to put all this investment, they might leave. But if you're able to retain people over time, that's like really where your money is made in retaining good people at the end of the day. If you're retaining good people. Same
person on the same client, I can make a lot of money. Switch one person off that client and you just know you're not going to do as well.
Yeah, because there's a lot of stuff they have to pick up, a lot of context.
Yeah, learning curve.
Yeah, no, for sure. And, I think we're seeing some challenges about that. One of the things, I'm just going to speculate here a little bit, but it seems like in the professional services industry, really the people are the assets and it's really hard to develop that. And you might just be better off acquiring that talent rather than trying to home grow that talent at the end of the day.
Well, I mean, first of all, it's not speculation. That is the asset. But, we coveted our people. And if you really covet your people and try and create that environment, you're going to keep them there. 5 years after we sell the firm, I run into people all over the time and they say, boy, that was the best place. There was nothing better than working at SS&G. It was the best. And, it makes me feel good about it, but we really try to create that amazing environment. that professional environment. And, looking back, I know you guys maybe haven't been around as long, but I think that we ended up having that kind of a reputation on a national basis. We were one of the best firms in the country. Maybe not the most profitable, but we were certainly willing to, continually investing in it and trying to move the organization forward.
What made SS&G so good for the people? You've mentioned a couple of the things.
It just let me give you just, you can go on and on, but let me give you one anecdote. Okay. I love this anecdote. So our employees understood that the accounting world was all screwed up and all the work happened in these 3 or 4 months. And this actually dates back to the middle 80s when there was a tax act. And what it did is it took all flow-through entities and made them have a calendar year end. How stupid was that? So there wasn't enough politicking to get that from not happening. So that's the way the industry is right now. All the LLCs, all the S corporations, they all end on 12/31. And you're inundated, and you're killed through April 15th. This year is different. So I conducted a bunch of, I went to every one of the offices with our marketing director, and I had just some fireside chats, and I would talk to our people. And what I kept hearing from people was, we get it, how hard we have to work during busy season. I mean, we get it, okay? You have no choice, okay, to that. But when we're not as busy, can you give some of the time back to us that we're taking away from our families? So what we ended up doing was, which wasn't easy to do, but I ended up convincing my partners that between Memorial Day and Labor Day, we would close every Friday. We would be closed. And what we did is we made it a 4-day work week, and we added an hour extra to the first 4 days. So it was a 36-hour work week, and we gave Fridays off. Now, before that, I used to go on the office on Fridays, and I used to think we were closed anyways. I used to walk around the office and never find anybody. And, what this meant was that every single person who worked for us could now have a 3-day weekend the entire summer. And what you would do is you'd see them take one of their holiday days and throw it on the Monday. So now they would have 4-day weekends. And it was a home run. My partners, you can't do that. We're going to go out of business. What about clients? Well, we established rules. And the rules were, you got to check your emails. You don't have to return them all. Let people know you're going to be back. Don't be irresponsible. Be responsible if we're going to give you this time. We didn't go out of business. I used to go in the office on a Friday. The only people in the office on a Friday were partners because they couldn't figure that out. We'd have administrative people in the office because, there was still things that phones had to be answered, things like that. So it was really successful. And then I would get groups like our employee benefit group would say, well, we can't, our summer's really busy. We really can't do that. So fine, well, we'll just adjust the schedule. So you'll start Labor Day and end Thanksgiving, but we'll give you the same kind of time off if you could take it then. So it was kind of like listening to our staff and giving back to them and trying to create some degree of a work-life balance with them going forward. And that's just an anecdote of the things we did. I mean, we allowed them, which we already talked about, we allowed them to invest in the organization. They made a significant amount of money doing that. We were really big on using things like, we ended up with multiple offices all over the place. We didn't want people to be traveling all the time. So we were really big in, using things like this kind of technology, going back 10 years ago. So, just trying to be aware of trying to, create some kind of work-life balance with our people.
The more and more we're going along with this conversation, I'm just really seeing, it's, people say real estate's a people business. Really, the accounting industry is a people business, and it's all about just, people are weird creatures, right? And it just seems like it's just all about being able to create an environment where if you're hiring good people are already going to be responsible. They're already going to hold themselves accountable to a lot of things, but then just working, making sure that environment, to your point, has a good work-life balance, and they're going to stay over the long haul. And you're going to be able to grow a profitable firm and not have so much turnover.
So I spent a lot of time, in this one of my new program, Managing Partner Bootcamp. But one thing I talk about is, what I used to talk about was the biggest problem in public accounting. It's not the biggest problem. It's now the second largest problem. But the biggest problem I used to talk about was that accounting firms were owned by baby boomers and populated by millennials. That was the biggest problem. And firms not realizing that and building millennial culture going forward. Brandon, when you talk about, what are the things we did? One of the other things I did, the foremost authority in the country in terms of a millennial culture was a woman named Rebecca Ryan. And I hired Rebecca. She spent 1 year with our organization helping us redefine our millennial culture as an organization. So what did that do? That had to talk things like dress, the quality of work we were giving people, being able to work virtually, understanding, what advancement meant in the organization. Learning and development was really a big item. So we spent a lot of times looking on trying to build this millennial culture, which reduced the turnover and really provided potentially for succession. The biggest problem in accounting today is firms don't understand that. And these firms owned by baby boomers are just, if they're going to be succeeded as an organization, they have to develop a millennial culture. If not, they're going to have to sell the organization or close the doors.
So switching gears just a little bit, if you would look back on this entire journey that you have been on, is there anything in particular that you would have done differently, had you had the chance to do it all over again?
Yeah, I've taken on this question before, and there's two things I would have done differently. The first thing I would have done differently is there's a couple of people I wanted to hire. I didn't get hired, and I wish I could have hired them, and I would have made it more of an effort too. One of them became a senior partner at Price Waterhouse on the tax side. Another one is she is a senior partner right now at RSM. They were both Cleveland people. I knew both of them. I coveted both of them, and I never. So people I didn't get that I wish I would have gotten. Number one. The second thing is just from a financial focus is I would have spent more time growing my ancillary businesses because they actually were much better than the accounting firm business. They were worth more. Not that I didn't do badly on anything we did great, but it's kind of like, I'm an idiot. The payroll company paid us significantly more when we sold it than did the accounting firm. I mean, if I would have taken some of my energy and focused it on the execution within that industry, if I would have doubled or tripled the size of the payroll business, it would have been worth a lot more. Wealth management as well, too. So in retrospect, I wish I would have spent more time with some of my other businesses than really the mothership. The mothership wasn't as valuable as some of the other things that we were growing at the same time. Who would have known,
That's really, really interesting. Also looking back on your journey, was there ever a particular challenge that you faced that was so great, so treacherous that you almost threw in the towel?
I had, nothing would ever throw in the towel, but I had the most, and I talk a little bit about the book, and this happened a really, really long time ago. It was actually in 1987. And what happened was my father-in-law had a CPA firm in Akron, Ohio, which is now called Apple Growth Partners. And it's a very successful CPA firm. And what happened was one of their key young partners was in that firm. When I moved back to Cleveland, I had a decision to make whether to go into my father-in-law's firm or my father's firm. My father's firm was much more of a challenge, and I didn't really understand that. But my father-in-law's firm was a much more successful firm at that point in time. We're talking about many years ago. So in 1987, this gentleman who was a key partner at my father-in-law's firm was unhappy there. He saw what I was trying to do at my little firm. He approached me and asked me if I would consider allowing him to leave my father-in-law's firm and come join me. And being totally inexperienced and naive at that point in time, yeah, this sounds great. He was a year older than me, had his whole career ahead of me, was going to be a key partner. So what we did under the cloak of darkness between February, maybe the beginning of February and April 15th, is we plotted for him to leave that firm and join my firm. Now, my father-in-law had retired, and he was no longer a part of that firm. He was being paid out. So once Mark Goldfarb came to join me, what happened was his firm that he was leaving, my father-in-law's ex-firm, put my family in the middle of the whole discussion and basically told me, well, if Mark leaves us, I don't know how we're going to be able to pay the retirement to your father-in-law. So now my father-in-law was involved my mother-in-law was involved in this discussion, and it was just a cluster. And it was really difficult. Now, we ended up negotiating that we bought the practice, and I'm not sure we had to buy it, but we ended up buying the practice. We paid them out over a period of time, and it was great. I mean, Mark was an incredibly valuable person moving forward in the organization, and he was a big part of where we moved forward in terms of having the right kind of people. But it was the stickiest thing I ever got involved with in my career was those negotiations. And at that point in time, 1987, I was a whopping 34 years old. So all of a sudden I was just in the middle of a quagmire.
So moral of the story is think about your future Thanksgiving dinners.
Yeah.
And if those are going to get super awkward, maybe approach it differently. Well, so, looking back after going through that experience, how would you have approached it differently?
In some ways I'm probably lucky, because probably the smartest thing to do would say, Mark, I can't do it. I'm not interested. The family's going to get away. And that probably was the right answer. But I was so foolish, so young, so inexperienced. I went the wrong way. And after getting through it, the value that was on the other side was worth the agony we went through. But really the right course is, sometimes you just have to walk away from deals. And that was probably a deal because of the conflicts that were inherent with it. I probably needed to walk away from.
Just want to circle back one more time to the ancillary businesses, right? So when you had those ancillary businesses, you mentioned they were much more profitable. Did they all feed each other, like in terms of referrals? And was it all this like big system that you had?
Yeah. It was all based upon one-stop shopping, doing more. Think about it, and what we would find is, which was always interesting to me, we wouldn't keep all of our clients, but I would lose a client and all of a sudden I'd find out we're still doing the wealth management, or they were still a payroll client, and we may have lost the accounting client. So they were all built to really feed on each other. Employee benefit administration, we were really big and really promoting 401ks, as the firms should have 401ks or KIOs or whatever back in that point in time. Wealth management became huge for us, significant practice for us in the dollars. And, this was working with your existing clients. 99% of our wealth management clients came from the accounting firm. If you looked at the top 100 clients in the payroll company, 95 of them were restaurant clients. They were common clients we had on the other side of it. So we used these to try and feed one another and just sell more to an existing client. And what you found is clients wanted to buy it, made business easier for them. They had a high degree of trust with you. And it was just an easier way to go about doing our business.
That makes sense. And just a quick question on the wealth management side of things, like what goes into a wealth management? Like what kind of services do you provide in that type of service?
Well, it would be the whole gamut. We would be, if you look at what a UBS office is today, or you look at a Raymond James office, somebody has an individual office, it would be more like a Raymond James model. We would work off something like that, but we would do, we could do the insurance side of it. So we could do insurance in terms of insurance for, a business. I'm talking about life insurance. We didn't do we didn't do product insurance. But it would be things like succession planning in a business. It might be estate planning for an individual. It might be things like disability income going forward. So there's the whole insurance side of it. And then what we would do is we would do personal financial planning, and then we would do the investing on the personal financial planning. So that would be the crux of what we did. We were managing, upwards of close to $1 billion in assets. And very, very successful, recurring revenue going forward. And, it really wasn't that hard to do that. And we started from scratch, and we sold that business a year ago yesterday.
And congratulations. It's an amazing story, I got to be honest. So is there any last words you'd want to impart on our audience before we go ahead and wrap this one up today?
Well, I don't know who your audience is actually going to be, but one thing I refer to as the biggest problem in public accounting, called professional services, is no longer the biggest problem. It's now the second biggest problem. And now the biggest problem is the genie's out of the bottle on the virtual workspace. Most accounting firms, they didn't have a virtual strategy. They had none. Okay, the biggest firms in the country did, but the other 40,000 had no virtual strategy. And what happened was people went to bed on March 16th, 2020, and they woke up on March 17th, 2030. And 10 years passed, okay, which is supposed to be an evolution, and it became an event. And firms have got to figure out how to practice virtually, and if it's just not what they think it is. We're not going to go back to where we are. And where we are today, we're not going to be where we are today, but we're going to end up somewhere in the middle. And firms have got to figure out how to do this in the middle, for all kinds of reasons. For employee retention, because if you go tell your employees they got to show up in the office right now and they're 30 years old, they're going to say, no, I'm going to find another firm to work for. And you have to be able to coordinate getting work done. And how do you do talent management? And what does the customer experience look like? And how do you grow the organization when every traditional thing we've done has been thrown out and has been changed? So firms have got to figure out how to work in this virtual environment. So those that do are going to soar. And two things have changed forever that are really positive for these firms if they could figure it out. The first thing is talent. Talent always had been for these firms based upon geography. And for the first time, talent for these firms is no longer based upon geography. You could get your tax manager in San Diego if you're in Cleveland. Okay, no reason that can't work now, but it couldn't work on March 15th. And the second thing is, why are your clients limited to geography? If you look at every accounting firm in the country, you're going to find out that 97% of their clients are geographically based upon where they're at. Why does that have to hold true anymore? It doesn't. So what's happened is those who can figure this out going forward, it's just an amazing opportunity. Incredible silver lining going forward for those firms who can figure out how to work in this virtual environment. It's really amazing.
That's a great insight. And that's part of our mission here for the Staying Power podcast and the Staying Power Collective is to help firms build a virtual practice so that they can succeed in this new environment that we have here.
Well, we can help them. At Winding River, we developed a virtual practice playbook series, and we're using some of our educators, and we focused on these 4 pillars and to try and help firms understand how to do this. And we're just starting to launch it over the last few weeks, and we're getting some interesting immediate results of firms that really understand this and want to learn how to do it.
It's good to hear. If the listeners of the show wanted to learn more about you or your business, how could they go ahead and do so?
We'll just go to the website. It's www.windingriverconsulting.com. You'll find everything you need to know. If anybody has any specific questions, you're more than welcome to drop me an email at gshamis, SHAMIS, at windingriverconsulting.com. Be glad to try and answer that for you as well.
All right. Awesome. Thank you so much for taking the time to come on the show today. Definitely appreciate it. It was a blast.
Thanks for listening. If you enjoyed the show, leave us a review on iTunes and share the show with other business owners who may be facing their own growth challenges. And if you own a professional services firm, consider joining our private community. The Staying Power Collective is a community where owners of accounting, law, and consulting firms discuss best practices for running and growing virtual businesses. You'll get access to our Slack group, and you'll have a Zoom meeting once a month with a small group of other firm owners. To apply for the group, head on over to www.stayingpowercollective.com and fill out the brief form. And if you have suggestions for future topics or guests, or if you have general questions or feedback, send us an email at contact@stayingpowercollective.com. Thanks so much for listening, and have a great rest of your week.